Here comes my best friend. I've always loved this one.
You get excited. That's
What? I get excited of
the
everything.
opposite for me.
Net present value.
How complicated is this that to be?
Okay. Notice the word here says net. That's the first word, net. Net of two things. So net suggests an offset. If they ask you to calculate present value, it is different from asking you to calculate net present value. Be aware.
So net present value, you have to have a tool.
Clearly there's something to be offsetted. Yeah. Present value is just present value. Yeah. So in this particular concept, we have the outlay, right? And we have the inflows. If I ask you to calculate the present value, I would be asking you to calculate the inflows over a period of time, and you just tell me what the present value of the inflows are. But net present value is where you take the present value of the inflows and you subtract the outflow. Makes sense?
So yeah, now similar scenarios except you have inflows and outflows
Yes.
taking place.
Over a period of time. Yeah. Still net. I'm just saying, be aware. Right?
But similarly with ARR, we could also have inflows and outflows, right?
That's why you have incremental revenue and incremental expenses. So it's the net. The average net.
So but then so the bottom part where you have initial or average investment, if you have like outlays every year.
Yes, you have to average it. Yes.
That'll be part of your
Yeah, because you-
investment or
yeah.
part of your expense.
Outlays is outlays.
Okay.
So that would be investment.
Essentially.
Right. So you don't have to average it out.
Costs and-
I guess that
Right.
would be the difference between the initial
Right.
investment versus the
So you know what your investment is. It's different. Revenues and expenses are different from investment.
Yeah.
Okay? So you need to be able to classify it and appropriately deal with it. But conceptually, yes, you may add more to your investment over time. And if that's the case, then you're going to have to use average.
the denominator
Yes.
in the last equation.
Yeah. With me? All right. So let's deal with net present value and get out of here. All right. Net present value approach. The net present value approach includes the discounted future cash inflows and outflows and compares the results with the what? With the initial investment. The future cash flows are discounted using what? What we call the company's cost of capital. Same as what we call the hurdle rate, right? And in some circles, sometimes people even use the effective interest rate. We're going to come to that, but don't be confused yet.
So the same as
Not yet. Just hold on. Hold on. I'll tell you when. I'll tell you when.
Okay. But you understand what I'm saying? Don't worry about these terminologies, right? Because really and truly,
But perhaps the exam uses, so it's good
right?
to know.
It's good to know. I know. Right? But sometimes you get locked into these. You know, it's like you have 99% of good stuff, and you get locked into 1%, and it probably won't even come.
This one here.
You don't know, right? Net present value, not just present value. I made that point already. Are you with me? So we're talking about a theory that is net present value. Notice everything that we have looked at already. What happens? It takes into account outlays, outflows, and what? Inflows. It takes into account your outlay and your inflows. Everything that we have looked at. So if we go back to payback or to discounted payback or to the accounting rate of return, all of them takes into consideration inflows and your outlay. And so even with the net present value theory, it does the same thing. Are you with me? The net present value concept looks somewhat like the discounted payback. The difference, however, is we're not working with what? Payback. We're working with absolute numbers. Right? Follow me closely. So the same kind of calculations you would somewhat do, but how you come to your decision is different. It's based on the value. Are you with me? Not the time or the rate. Okay? So if you can remember that, then you have 4 methods under your belt.
Are there more?
What's wrong with you?
It's like, what did we do for now?
What's wrong with you?
No, I just asked if there were more.
We haven't even.
You
Yes.
said we have 4 under our belt,
Yeah.
which makes me feel like there are
At least 2
others
more.
for us to learn.
Yeah, at least 2 more. Other than these 4.
That's where I was going.
Okay, so if you're called to make decisions, how would you make decisions? Based on whether it's a standalone project or based on whether it's a what? A group of projects. If it's a standalone project, you make decisions based on whether the net present value is positive. So you're going to make the decision built around whether the net present value is positive. If it's positive, you what? You accept the project. You go ahead with the project. Are you with me? If you are comparing 2 or more projects, then typically you will go with the project that has the highest NPV. And again, I have reiterated. Right? So when Sunday come and I ask you this question, make sure you all know it. Because so far I've only said in one instance that depreciation is included. And that was which one? Accounting rate of return.
Yeah, but both
Right?
include the storage and yeah.
And with the accounting rate of return, I said you need to include your taxes and all these things. Are you with me? Right. Okay. With the other methods, you give consideration to the tax effect. Now, Ricky, here we go now. Okay. Remember, the present value of $1 or a single sum versus the present value of what? Ordinary annuity or annuity due. Now, let's go back to annuities. There are 4 ways or 4 titles to annuities. What are the 4 titles to annuities? I give you 2. Ordinary annuity. What is the other name for ordinary annuity? Don't say it, Bobby. What is the other name for ordinary annuity?
Advance. Oh no, advance is the due.
What's the other name for ordinary annuity? I told you this.
Okay.
No, he did telling us. I remember. It's in my head. I remember.
Why is it ordinary? Think about it. What makes it ordinary, Nick?
The one we typically use.
Or it typically operates.
Or it typically operates.
Yeah.
Which means, at what point in time do you typically earn or pay interest? Very good.
Yeah.
So what's the other name for ordinary annuity?
Annuity.
In
Arrears?
arrears.
Yeah.
Wow.
I know this one.
Okay? Yeah. So what's the other name for annuity due? Annuity in advance.
That I remember that one.
So you have ordinary annuity. They call it ordinary because of its behavior. You don't usually earn money at the start. You earn or pay interest at the end. So the other name for ordinary annuity is annuity in arrears. The other name for annuity due is annuity in advance. So Nick, you're asking me for the type of questions that they would give you. If I give you a question and it's around bonds, which of these concepts would you use?
Annuity due. Well, I mean,
If I give you a question, Nick, and it's around leases, which one of these concepts would you use?
Annuity in arrears.
Why?
The leases?
Well,
When do you pay your rent or your lease?
true.
First of the month. So go back again. I'm going to ask you the same question.
Okay.
That's how you're going to know. Right?
Ordinary annuity.
So when they give you the question, that's how you're going to know. They'll tell you this is a bond question, this is a lease question, and they will tell you in the question when the payments are
Bond
being
is
made.
ordinary, right?
What's that?
Bond is ordinary,
Conceptually.
right? And then leases, of course, would be the due.
Conceptually.
Yeah.
But if you go back to what I said in last class, they might confuse you because I could say bonds are paid at the start, or I could say leases are paid at the end. So if they say leases are paid at the end, what are you going to use?
Ordinary.
Yes. But conceptually what I'm saying is leases typically are paid at the beginning and bond interest payments are made at the end. No, not the first time. But that's how you're going to know. That's how you're going to know. They'll tell you these things and they will give you enough information in the question. And based on what is in the question, you should now know if you're also going to use an annuity or a dollar concept. Because there are two concepts here. You have the present value of an amount concept. So you have the PV of an amount. And you have the PV of an annuity concept. Okay? So these are two broad concepts you have. The PV of an amount or the PV of a what? Of an annuity. Watch me. Watch me, watch me, watch me. Now, the PV of an annuity, there are two types of annuity. So you can have the PV of a what? Of an ordinary annuity, or you may have the PV of a what? Annuity in advance. Are you with me? Now, what is the difference between the PV of an amount concept and the PV of an annuity concept? When would you use which one?
It depends on like the terms.
Depends on the terms, fine, but yes, go further.
If it says that it's being paid annually
Uh-huh.
or monthly, or if they give it, if it's multiple times per
Series
year,
of payments.
There we go. That's
You would use what?
the annuity.
Okay.
But if
And
it's just one lump sum,
if it's just one lump sum, one payment, etc., etc. But they will give you a question that has what?
Both
That has both
combined.
okay, where
And
there's a lump sum, and
there's a
then
lump
also
sum, right?
thereafter you
There are
would
a
pay
series
X
of payments.
amount.
Yes. So let's say I say, okay, the loan is being repaid every year, same number, equal number of payments, but at the end there is a one-time lump sum payment. Or if you get a question with salvage value, for example, salvage value is usually one time, and it's usually when? At the end. So you'd have to apply to the salvage value the present value of an amount concept, and then the series of payments or income before the salvage value, you would have to apply what? The present value of an annuity. So some questions would be, the answer would be equal to the present value of an annuity plus the present value of an amount. Some questions, it would just be the present value of an amount. Some questions, it's just the present value of an annuity. But you have to read through the questions and break it up in a way to apply the appropriate concept. But what I'm saying here is that these concepts, you have to keep them here. And when you read through the question, you have to now structure your question to apply the appropriate concept. Are you with me? Okay? Another thing I see where they do in some of these questions is this. They will give you the factors for an annuity in advance. So they will give you the present value factors that you should use for an annuity in advance. And they will also give you present value factors for an ordinary annuity. And you must know which one. Or they'll take that a little further. They'll give you annuity in advance and they expect you to be able to work out.
Child.
Well,
Yes.
You can
I'm
do
going to
it.
show you how. It's easy.
You're not
Because most
sure
times you
why.
add or subtract one.
One. Manipulate the factor.
Manipulate the factor, which is where we're going to go. Right? We're going to get there.
When, on Sunday?
Yeah, we're not going to finish now.
Okay.
Right? But follow me here, right?
Yeah.
You understand what I'm saying
I
here?
do.
All right. Because we. All right, so let's look at this example. A company is considering an initial investment of what? 100,000. And what? No residual value. The cost of capital is what? 10%. The investment is expected to provide the following what? Cash flows. Right? So you have all the cash flows there. The question is, what is the present value? What is the net present value? And should we what? Accept or reject the project? Right? So we don't get into this yet. Nothing in this worry. You don't need to worry about this yet. But just to clear up the concept. Right? All right. So let's look at this one. This is year 1, year 2, year 3, and what? Year 4? And we have 25, 20, 90. 25,000 minus 20. This is 90. And this is what? 40. And the rates were, the discount rates were what? The PV factor was what?
909,
0.909,
0.826,
0.826,
0.751,
75 what?
1,
And what?
0.683.
0.683. All right. So the first thing we need to work out, based on what I've been telling you, is what?
PV.
The PV. And that's easy, right? Just number crunching.
22,725.
22, 725,
16,520.
16,520,
Minus that one.
67,590.
67,
590.
590,
27,320.
320. So the PV here, the present value is 101, 115. That's what you got?
No.
What did I do wrong? 22, 725 minus
You have to make
16.
a minus, but probably didn't do the minus.
Yeah, I did the minus. Minus 16,
Maybe you didn't do
250
the minus.
plus 67, 590 plus 27, 320.
What'd you get?
Yeah,
That's what I got.
101. Yeah.
Keep look at the
Because
minus.
year 2 is a minus number.
So when
Oh,
do we
yeah,
have
yes,
minus?
yes,
When the cost was higher than.
Yeah.
Okay.
Getting maths from
Did you accidentally?
All right. So this is your what? This is your PV, right? So your net present value would be, we now have to bring in what? The outflows or the outlay? Right? So the outlay is 100,000. So your net present value becomes what? 1115. And that's a positive number. So would you accept the project? Would you go ahead with the project?
Yes.
Yes.
So at this point, we concern only the value, not the time.
Yes. But notice the calculation is really what? The same. So,
the outlay was in the current.
yes.
But if it was in the middle,
Right. So this would be year 0, right? So always remember this is year 0. And so the PV factor of year 0 is what?
1.
1. Okay? The PV factor of year 0 is always 1.
Okay.
What's up with this cost of capital number that keeps being there?
Yeah, we're going to talk about that. Don't worry. What I'm saying is that's your discount rate. That rate is what you use to determine your PV factor.
Yeah. So that
Right.
10% is in that PVF
Right.
for each year.
He's asking about, it says here the cost of capital, or you had asked the cost of capital is
Right.
10%.
And can you repeat what you just said just now? When you were like, don't worry that they call it cost.
Yeah, it's not really cost per se. It's really how much you expect to make on your money. Are you with me? Or the opportunity cost of your decision.
Good.
But it's not really a cost.
Okay.
That's really what I'm saying.
Okay.
So if you go back to what we said earlier, where was this? Right? Using the early rate, right? And I think I had another slide that linked the early rate to your interest rate. They're all
Right.
kind of like sisters and brothers.
So hurdle rate is what what I need to get back from my money for, or
Technically.
my money needs to jump over for me to be like, oh,
Good.
Technically.
Jump over.
That's right. Right. Technically.
investment.
Right.
Okay.
Jump over.
Technically.
Gross, yeah.
Perfect.
Makes sense.
So it's
If I
probably
had you
9:30.
in undergrad,
Ciao.
I won't even be doing
I would have gone to Harvard.
I would not have even be doing the CPA.
I'm just like,
I would
what
have
did I do
done
on the
it.
last exam? I don't remember any of those.
And Oxford.
All right. So we'll stop here. We'll on Sunday. The other one I wanted to do was the internal rate of return approach, but it might take more than.
Good money right here.
Yeah, it's going to take more than 30 minutes. Right? But go back through all the four all the four methods that we talked about, and make sure you go back to present value, because present value, follow me, Ricky, present value is now going to flow into IRR. So for you to understand IRR and what I'm going to do to show you how to calculate IRR, it's important that you understand how to calculate present value. Are you with me?